This is Nick here, and I'm about to go through the updated chart book for U.S. inflation. So here, starting on the first chart, is an average of four inflation rates. So the headline rates for CPI and PCE. So PCE is the Personal Consumption Expenditures Index, and CPI is the Consumer Price Index. Those year-over-year rate of changes plus the year-over-year rate of change of the core readings for both PCE and CPI take the average of those four rates of inflation, and that's what we're looking at here. So that's risen to 2.36% year-over-year. That's a high since early 2012. And one thing you can see on this chart, and one thing I think is generally true, tends to be true, is that you see inflation picking up in the late part of a business cycle, and prior to the recession, one tends to see inflation running at a relatively high rate. The dotted line here is the Fed's inflation target that is set at 2%, and that is technically relating to the headline PCE inflation rate. So we do see inflation starting to pick up. Now, some of that is, I think, relating to what are called base effects. So in addition to looking at the year-over-year rate of change, I think it's worth looking at the actual index levels themselves. So the year-over-year rate of change is the first derivative of the index, and here we're looking at the underlying indexes. So the black line is the CPI index, the gray line is the PCE index. And you can see that around this time last year, basically, for about 6 months here, the index was relatively flattish, and what that does is potentially create higher inflation readings a year later because of these subdued index readings the year prior, 12 months prior. So when the index is flat or dipping down here, that creates this effect where the year-over-year reading is going to potentially jump a little bit higher, just purely based on the math of taking the numerator divided by the denominator to get the -1 to get the year-over-year rate of change. And so we are seeing these higher readings that are seen here. Some of that, I think, is due to these base effects that we've been expecting to see during these 2018 summer months. A big part of that has to do with oil prices. Here is the one-year chart for oil. This is the cumulative percentage change over the past year. You can see that basically in late June, oil prices had a recent peak. Right now, they are about 40% higher on a year-over-year basis. This could, depending on what happens with the oil price, but given that we had this relatively high level for oil in June, we could see some negative base effects at work June of 2019. So that's worth just being aware of and keeping an eye on. I think both the index chart and the year-over-year or the cumulative percentage change over the past year for oil are worth monitoring, because these base effects can be short-lived and you'll see them dissipate, and you don't want to be wrongly extrapolating this trend out forever when you've got some funky base effects at work. Then, keeping with the oil price for a minute here, that's the gray line. One thing that we notice is that the inflation expectations, which are the black line, so this is the annualized expectation for CPI over the next 5 years, and that's based on a market price on an over-the-counter derivative contract that's traded and settles on the basis of the underlying CPI index. So that's a direct market-based measure for inflation expectations. You can see there's somewhat of a relationship between inflation expectations and the oil price. So as the oil price has come down here over the past couple of months, we've seen the inflation expectations come down a little bit as well. Then in terms of labor costs and wage inflation pressures, here we have the ECI, or the Employment Cost Index, which is a quarterly number, and many economists think that this is the best measure for looking at underlying inflationary pressures with respect to sort of cost push inflation of of the cost of labor as an input to production. That's been trending higher here. That's reached a new cycle high at 2.8% year over year on the employment cost index. And then on the gray line here, we have the NFIB Small Business Compensation Plans Index. And I've led that by 3 months to show that there is potentially some kind of a leading indicator quality to that. And that is a monthly series, so that's updated more regularly and can give an idea of where this ECI index might be headed, which for now we can say that this NFIB Compensation Plans Index does continue to look like it's trending higher here. Then this relates to the concept of what's called the Phillips curve, which is basically the idea that as the unemployment rate comes down, wage inflation should pick up. So the unemployment rate, the U3 reading, is in gray here. Then the year-over-year average hourly earnings for production and non-supervisory employees is in black. You can see in prior cycles that there's been more of a pickup in wage inflation as the unemployment rate has come down to levels that are consistent with where it is now. In this cycle, we haven't seen that wage inflation pressure as acutely as you might expect. That has been something that some Fed officials have pointed out that's been puzzling to them. But in general, we do see a trend higher here in terms of average hourly earnings, although right now at 2.7% year over year, whereas when the U3 was at this level in prior cycles, that reading would have been closer to 4%. Then capacity utilization, that's the gray line here. That's led by 15 months to show the potential leading indicator quality here. That has been generally trending higher, and we've got the core CPI year over year in black, although that has really shot higher in the past few months. Then moving on here to GDP growth and inflation. So the gray line is the year-over-year real GDP growth. That's at 2.8% through the end of Q2 2018. Some loose relationship potentially there with the core CPI reading year-over-year in black. And again, there's been a shift here, moving this gray series forward by 18 months to potentially show the leading indicator quality of that time series. Then moving on to U.S. manufacturing PMI, again the gray line shifted forward here, in this case by 24 months, and mapped against the core CPI year over year. So if this relationship is genuine and holds, roughly we might see the inflation reading continue to rise, essentially what looks like through the end of next year or end of 2019. Then this is a demographic indicator that has been interesting to me. It's the year-over-year rate of change of the age group that's 15 to 24 years old, led by 7.5 years, and it seems to show somewhat of a relationship with the core PCE reading year-over-year, which is the black line. And if that is a genuine relationship, and if that has any predictive power, it suggests that maybe, again, inflation could be trending higher with some ups and downs, but trending higher through the end of next year. Then a longer-term, bigger picture for demographics and inflation. So this shows the gray line here as the 16 to 20-year-old age group as a percent of the labor force, led by 7.5 years, as well as the black line being the CPI year-over-year 10-year moving average of that inflation reading. And pretty loose relationship here, and we just don't have data going further back than this, but it does suggest that possibly demographics played a role in the run-up, in the inflationary run-up of the 1970s. And if that is, again, if that's a genuine relationship, it looks like, to the extent that demographics are playing a role on inflation, it looks like it will have a subdued or disinflationary effect over the coming several years. Then the U.S. Inflation Surprise Index from Citi. So I think that this one's well worth tracking. We haven't seen inflation readings really surprise on the upside yet. In the past couple cycles, we have seen that happen late in the cycle, heading into the recession, and as a base case scenario, I would expect to see that again. So that would be almost a business cycle indicator as well to see this inflation surprise index above 0 as a potential late cycle indicator. Then I've got my summary comments, which you can take a look at on the PDF. But basically, base case scenario is that we might see inflationary pressure continue, with some ups and downs, of course, but generally continue through next year. I think some of the base effects will soften over the coming months. So in the short term, we might see some softening on the readings, but overall would expect inflation to trend higher as capacity utilization and labor market resource slack is reduced. And then longer term, primarily because of demographics, I would expect to see the disinflationary trend continue. I mean, one country that I like to look to as for guidance on that is Japan. Their demographics are well ahead of ours in terms of the aging of their society, and we generally see an ongoing disinflation there. All right, let me pause there and would encourage you to look at the PDF for further commentary and explanations on the charts.